Hello learners, welcome to the course on Essentials of Financial Management. Here we are in the process of discussing the capital busting techniques, and so far we have discussed the capital busting techniques which is used normally in the case where we can accurately measure the cash inflow and cash outflow. We can also estimate with some amount of accuracy the cost of capital and also the economic life of the project. But friends, in the real life situation, it is very hard to estimate all these variables with a greater amount of certainty, and that is how there is a need to see whether there is any technique which can help the finance manager to use the method which can gives us the foolproof decision in the case where there are so much of uncertainties and risk. And for this, there are certain techniques which is used in the case the investment proposals are not certain how much cash inflow would be generated, how much cash investment outlay is required, what would be the size of the investment, what would be the economic life of the project, and what would be the pattern of cash inflows. So, with this we are here to help you to have some kind of understanding like what are the appraisal techniques which can be used for evaluating the long term investment proposals under the risky situations. The question arises, what is risk? So, risk is the situation where though we have encountered this kind of situation in the past, but yes, it has given us the mixed results. Sometimes it has become a successful venture, but sometimes it has failed. So, here can be two type of risk in all the projects. Number one is the business risk. When there is an uncertainty with regard to sales and the profit, it is known as the business risk. But when there is a risk in the project which comes from the use of debt, it is known as the financial risk. There are several subcategories of the financial and the business risk which may range from liquidity risk, market risk, transaction risk, and so on. So, here we are going to discuss some of the methods which can help the manager to find out the most viable project in the situation of uncertainty. The first method here is known as the RADR, risk adjusted discount rate. Friends, we have seen that all the future cash inflows are converted to their present value. What is the rate? What is the PV factor that is helping us? It is the discount rate, and this discount is nothing but the WACC, weighted average cost of capital of the company, or which is known as the hurdle rate, or even sometime as the cutoff rate. So, in this case, under the condition of certainty, we have a certain that is say 10% or 15% is the discount rate, and this discount rate is used to convert the future cash flow to its present value. But in the case of RADR, because we are not certain about the riskiness of the project, here we are going to use one term which is known as a risk premium. So, discount rate is bifurcated into two parts. One is known as the risk free rate and other one is known as a risk premium. Risk free rate is same for all the projects because it is coming from the external environment, whereas the risk premium is associated with the specific characteristics of the projects. Hence, it would vary from project to project. So, in order to summarize, let us say what is RADR. The RADR method is the discount rate which adjusts the discount rate according to the riskiness of a project. For a higher risk, the projects are evaluated using a higher discount rate, while less risky projects are discounted utilizing a lower rate. Now, the discount rate would be increased for projects and it will be decreased depending upon the nature of the project in terms of their riskiness. And the difference between the required discount rate is nothing but the risk free rate is called the difference between the RRR, that is the required discount rate, and the risk free rate is known as the risk premium. And in simple word, risk premium is the compensation to the investors for assuming the higher risk in a project where they are investing their funds. The formula for computing the NPV under the RADR method is the NPV is equal to summation of all the cash inflows discounted to their present value using the discount rate, which is reflecting both the RF plus RP minus the initial investment. So, that is the way we should incorporate the risk of the project cash inflows. Similarly, we can also use the profitability index method, where the present value of cash inflows would be divided by the initial investment. Now, look at the problem where we can understand how exactly the RADR method is used in practical situations. In this problem, initial outlay is rupees 1 lakh, where the project is giving 40,000, 50,000, 15 and 30,000 in next 4 years. The risk free interest rate is 10%, but here the risk premium is 10%. What does it mean? I have already told you that the discount rate is equal to RF plus RP. So, here the discount rate would be equal to 10% plus 10%, that is risk premium. So, it comes out to be 20%. So, this project would not be using a discount rate of 10%, rather it will be using a discount rate which reflects the additional risk associated with the project. So, an additional risk premium of 10% would be added in the risk free interest rate. So, making the discount rate as 20%. I hope this is clear how exactly the discount rate is found out, and it is by adding up the risk free interest rate and the risk premium. Now, we are here to apply the same concept for discounting the inflows to their present value. If we look at the cash flow for the project A, this solution refers to the project A. So, it is 40,000 in the first year, and at 10% the PV factor was only 909. So, the PV of cash flow was 36,364, but if the same 40,000 is discounted using a discount rate which has the additional risk premium embedded into it, now the PV factor at 20% will be 0.833 and the PV of cash flow would be as low as 33,333. So, we are going to show you the result when the risk free rate is used for discounting the cash inflows and the present value of all the cash inflows when the discount rate is 20%. So, this was 10% and this is the result of 20%. So, here the NPV is 9,446 at 10%. When the same project was discounted using 20% as the discount rate, we can see the project which seems to be very viable, it was worth selecting, has been giving the negative NPV, that is 8,796. So, it is particularly true that the discount rate is a very important factor for finding out the true profitability of any project. So, if we ignore the risk, definitely we would have selected the project because it was giving us 9,446 NPV, but at a rate of 20% the same project seems to be a unviable project. So, this is the answer for project A. Let us repeat the solution of project. This is the solution for this problem. and we could very well understand how the difference on account of risk can alter the decision of the management. So, project is not going to be selected by the management. Is it clear to everyone? I hope. The process is same as those of calculating the NPV. The only difference lies in the fact that instead of discounting at risk free rate, now we are discounting at risk adjusted risk. Method is, it is very simple and very logical to be used by the management. It is directly adjusting the risk in the discounting process, where the R, that is the rate of interest, is reflecting the riskiness of the project. And this is a very flexible method because it can be adapted for different risk level by changing the discounted. Suppose in this case we have seen the project was having a risk premium of 10%, but if sometime management feels that it is quite pessimistic to assume risk premium to be 10%, rather it can be just 5%. So, in that case it is 10%, 15% would be the discounted. So, here depending upon the attitude of the management towards risk perception, here the RADR can be changed. When it comes to demerit, again the strength of the method can also be seen as a limitation, because there are a lot of subjectivity in the process of assuming the risk premium and thereby discounting the cash inflows to a present value. There is no standard scale whereby the additional percentage of risk premium can be added to over and above the risk free. It may or may not reflect the true risk, and also sometime it is ignoring the other method of incorporating risk, say standard deviation and the coefficient of variation for measuring and incorporating the risk in the capital busting exercise. The second method is certainty equivalent coefficient. Friends, we have seen that in RADR we have incorporated risk in the denominator, if you look at the equation, but in case of certainty equivalent coefficient, it is going to adjust the risk in the numerator, that is the cash inflow. So, under this method the capital busting and financial management would try to handle the uncertainty and risk in future cash flows by incorporating the certainty equivalent coefficient in the numerator. So, this approach would reflect the principle that rational investor prefer a certain return to an uncertain one, even if the expected value is the same. So, in this case it is a situation where the expected cash inflow would be converted into certain cash flow. And how we can achieve this? We can get the certainty equivalent coefficient by dividing certain cash flow by risky cash flow. So, this is the method which is going to convert the risky cash inflow, expected cash inflow, to the certain cash flow, and the same value of alpha would be used to convert all the expected cash inflows to their certain cash flow values. So, here this is a practical problem where the initial outlay is 50,000 and project is giving 32,000, 27,000, 20,000 and 10,000 in 4 years, but the management have realized that there is a guarantee to the extent of 90% that 32,000 would be generated in the first year. What does it mean? This 0.9% is the certainty equivalent coefficient, and this will be now used further to find out the certain cash flow. So, look at the figure of cash flow. The same figure is multiplied with the certainty equivalent, that was the 0.9 in the first year. So, we get the value of certain cash flows as 28,800, and by doing this exercise we would be converting all the expected cash flows into these certain cash flows, and then the process will be similar as those of converting to their present value by utilizing the PV factor. So, we get 49,132 as present value of future cash flows, and from this if we subtract 50,000, that is was the initial investment outlay, we find that the project is giving minus 868, and since this figure is a negative one, we are going to reject the projects. So, I hope you remember the specialty of this method, where we are having the certainty equivalent coefficient for different cash inflows. It will be multiplied with expected cash flow to get the certain cash flow, and thereafter the PV factor would be multiplied with the certain cash flow to get the present value, and from this we will deduct the initial cash outlay, and if the NPV is positive we will select, otherwise we will reject the project. As far as merit is concerned, it is also going to adjust for risk explicitly in the numerator, that is the cash flow. Then it is using the risk free rate. So, there is no complexity involved in this process of adding a risk premium over and above the risk free rate of interest, and many a time the investors who are risk averted would try to know, would be interested to know what is a certain cash flow instead of the expected cash flow. So, again there is a flexibility of having this method used for different kinds of project. As far as demerit is concerned, there is a lot of subjectivity involved as well, how to fix the certain equivalent coefficient, and there is also a difficulty in estimating the cash inflows and certain other variable like the certainty equivalent coefficient, which is also known as the alpha value. Then there is a lack of standardization, because there is no universally accepted way to determine this alpha value. Now, there is another analysis which is very helpful in taking the right decision in the uncertain scenario, and this is known as the sensitivity analysis. Sensitivity analysis is a technique which is used to determine how the variation in the output of a model, that is profit, NPV or any other key metric, depends on changes in the input variable. So, that means it would try to find out what changes will take place in NPV given a change in any of the independent variable. Probably it may be the variable cost, it may be the fixed cost, it may be the selling price, and so on. So, formula for calculating the sensitivity is percentage change in output given a change in percentage in output. Alternatively, we can also calculate as new output is equal to base output multiplied with 1 plus change in the input. Let us take a problem. The cost of capital here is 12%, initial cash outlay is rupees 3 lakh, effective life of the project is 10 years, and present value of interest factor at 10% is 5.65, and where from we are getting this 5.65? It is when we are having the effective life as 10 years and the cost of capital is 12%. So, at intersection point of 12% and 10 year, this 5.65 value is lying, and we can now use this for evaluating both the projects. Project A and B is expected to give us annual cash inflows 65,000 and 25,000 respectively in pessimistic conditions, whereas expected cash inflow will be 75,000. If this expected scenario is the most likely scenario, where both the projects are given to give us the identical results, where the optimistic scenario may result in an annual cash inflow of 90,000, whereas the annual cash inflow may go up to rupees 1 lakh in the case of project B. Let us find out what is the NPV in the different scenario for the project A and B. So, if we multiply the annual cash inflow with the present value interest factor, we see that the PV of cash inflow is 3,67,250, whereas NPV is 67,250. In the expected scenario, the NPV is 1,23,750, whereas the optimistic scenario may give us NPV as 2,08,500. So, we can see the range of NPV, which is 67,000 in the pessimistic scenario, whereas 2,08,500 is the most optimistic scenario. Look at the result of project B. The project B is expected to give us 1,23,750 in the most likely scenario, which is quite similar to that of project A. But look at the case when the pessimistic scenario prevails, the project may result in a minus figure of NPV, which is minus 1,58,750, but the situation is very surprising in optimistic scenario, where NPV may go up as high as 2,65,000. So, now sensitivity analysis is going to give us the idea like what would be the range of NPV in different scenario. So, for project A, the range is obtained by deducting the NPV in optimistic scenario and the NPV in the pessimistic scenario. So, the range or the difference in the two extreme situation is 1,41,250, whereas project B is even more risky, whereas we can see the range of NPV is as high as 4,23,750. Now, here lies the importance of attitude towards the risk. If the management is risk taker, they may take high risk for high gain, because gain will be as high as 2,65,000. But if the management is very conservative, or it is risk averter, then it may go with the project A, because here there is a the range between NPV, the range within which NPV lies is quite lower as compared to the project B. So, this is the use of sensitivity analysis. It would give us which variable is most critical variable and which should draw the maximum attention of the management. It would also help in risk assessment and decision making under uncertainty, which was not possible by the other method like the payback period method or NPV method or the internal rate of return method, which have not given any consideration to the riskiness of the projects. And as a result, these this analysis, this sensitivity analysis would also support the management in maximum utilization of the resources available with the fund. The demerit of this project may be understood from the fact that here under sensitivity analysis, we change one variable at a time and keep all other variable constant, so as to see the impact on the final outcome, that is the NPV. But in real life situation, it is possible that all the variables are changing simultaneously, like when the variable cost is increasing, the selling price is increasing, maybe the fixed cost is increasing. So, in that case, this sensitivity analysis is going to be of little help, and this does not account for probability or likelihood of changes. It only sees the impact on the final outcome. So, these are the merits and demerits, but no doubt it is a very important technique in the hand of the management, which can see where to allocate maximum resources, which variables to be paid most of the attention by the management, and that is how the management would be benefited by this techniques. Now, if you compare all the three methods of incorporating risk in the capital budgeting, we see that the focus of RADR is adjusting the discount rate, that is the denominator, whereas the under CC method risk is incorporated in the numerator. In sensitivity analysis, it is going to test the input variability impact on the final outcome, that is the NPV. The key input under RADR is risk premium. Under CEC, it is the alpha value, which is the certainty equivalent coefficient, whereas sensitivity analysis is going to have so many variables as the key input. The strength of the RADR is very simple, and it is very clearly giving us how the risk would be incorporated utilizing the risk premium, and CEC mostly based on the tolerance capacity of the invest. Weakness of the RADR lies in the fact that we cannot determine the risk premium with great amount of certainty, whereas subjectivity in coefficient determination is also an important drawback of the CEC, where sensitivity analysis is trapped into the over complications by incorporating many variables at the same time. There are other analysis which is also helping the management, which known as the scenario analysis. We have seen one of the assumption under the sensitivity analysis that we are changing one variable at a time, but in scenario analysis, if so many variables are changing simultaneously, concurrently, the scenario analysis can find out the impact of changes in the variables simultaneously on the final outcome, that is the NPV. There is another technique which is known as the Monte Carlo simulation. It is actually using the probabilistic model to generate thousands of outcome based on variable distributions. And advantage of this method can be that we have been able to quantify the probability of achieving target return by adding and risk quantification, but this is very complicated method and requires lot of computations with the help of certain software. Decision tree analysis is actually a graphical and analytical tool which is used to support decision making under uncertainty, and this technique will be helping managers and analysts to map out different possible courses of actions, the possible outcomes for each actions, and also the probability and payoffs associated with those outcomes. This is the comparative overview of the sensitivity analysis, scenario analysis, RADR, Monte Carlo and the decision tree, which can be referred for having a bird eye view of comparative study of these methods available with the business organizations. There can be other appraisal techniques which is equally useful in the case of uncertainty, like terminal value method. Actually, this is based on the assumption that each cash flow is reinvested in another project at a predetermined rate of interest, and by using these assumptions, the terminal value is calculated, which is nothing but the cash inflow which is compounded annually at the given rate up to the end of the project, and this compounded value of all cash inflow is then discounted back to present value, where we are using the cost of capital as the discount rate, and if the present value of the compounded cash inflow is greater than the original investment, we of course would be in favor of the investment, otherwise project may be rejected. The terminal value is important because it allows for reinvestment of cash inflows as they are received. So, here we assume that all the intermediate cash inflows are reinvested and the compounded value is calculated only at the end of the project. It is mathematically easier to compute with the help of table also, unlike the IRR where we are picking one rate after another and trying to find out the rate at which NPV becomes 0. It is also very good for cash budgeting requirement, where management is interested to know how much cash could be allocated for the different projects, and it is also easier to understand. There is another technique which is known as the annual benefit or cost rate, where instead of using aggregate discounted value, it would relate the average annual return to average outlay. So, here we are going to average out all the income received in the future year from the project, and similarly it will be related to the average annual outlays to find out if the rate of return is greater than some predetermined rate which has been specified by the management or not, and if the ratio is greater we accept the project. There is another technique known as the net cost approach. This method involves the minimization of average cost reduced to present values of the entire productive activity of the firm, present and the future. It is widely used because it is a very popular method, and this method is complicated a little bit by the enigma of cost imputation in joint product manufacturing, where companies using or producing more than one project, then how to associate the cost incurring on project A or project B. So, in that way only this is not very much useful for the business organization for incorporating risk. So, with this we have seen that unlike the situation where we can use payback period method, accounting rate of return method, NPV and IRR, there are techniques which is equally beneficial for helping the manager to take a decision when there is lot of uncertainty in the environment, and project which should be selected is selected only after giving due consideration to all the risk and return emanating from the project. So, with this we have come to an end of this discussion on the project appraisal technique under the condition of risk. Thank you very much. Thank you.